I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone riding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, stock market investors tried to hold things together early in the week after last Friday's huge rebound, with the S&P 500 gaining 94 points on that day. The indexes had small gains through Tuesday as Home Depot came out with good earnings and guidance, and the stock market on Tuesday flinched only momentarily to the downside after Fed Chair Powell came out and said they won't hesitate to keep raising interest rates until inflation comes down. So there goes the Fed put. It was Wednesday when things really came apart, as mortgage applications plunged to start the day, of course, as mortgage rates get up over 5%. And then target earnings were a disaster. The stock plunged 25%, its worst day since the crash of '87. The retail sector got crushed on that day as inventories are rising, and it's clear that inflation is both hurting the consumer and squeezing margins for the companies. And besides retail, consumer stocks, both the consumer staple and discretionary stocks, got crushed, which shows you there is no safe haven. Actually, consumer discretionaries, the worst of it, down 33% off of its peak. It's actually worse than the NASDAQ. On Wednesday, after all that news, the Dow fell 1,200 points, its worst day since June 2000 during the pandemic. Thursday stocks were weak again as Kohl's came out with another bad retail earnings report, and Fed George came out and said higher rates are needed, and they are not focused on the stock market. They are trying to now be able to get some normalization in and try to restore their credibility. I have a lot more to say about that in a couple of minutes. Apple was down again on Thursday as analysts cut their targets to 200. Well, the stock is trading about 137 right now. Our downside target was down to 138, maybe as low as 130. And I just want to say to that analyst, you're fired. Of course, Apple is a consumer stock, so it's under tons of pressure with that group. But on Thursday, stocks tried to stabilize, with some techs getting rebounds, small ones, but then sellers came in, as we see every day, and the market failed again. Friday in the morning, the market got a lift as China cut their interest rates. They're trying to stop the bleeding in that slowing economy that they have shut down because of the pandemic. And Deckers came out with great earnings, really another anomaly compared to the rest of the group. And there was a small bounce. As prices do look cheap and the indexes are trying to set some kind of a bottom, the S&P's pre-market were up close to 40 points, but then the sellers came back, and of course we're in a time where sometime in the morning the investors get hit with margin calls, and they start to pull money out of funds, and we saw another big decline as it went from up 40 to down 40 on the S&P 500. Now trying to rebound a little bit here at midday, but the stock market is just being overwhelmed by sellers right now, down about 28 points on the day here on Friday. The stock market is in a time in which indexes are getting sold very hard, but individual stocks are getting obliterated. So many analysts I've heard on TV and read on social media are calling this a correction. It's their way of not admitting their poor analysis and denial of the obvious. and it gives their investors a reason to stay in. Well, they're looking at 5-year and 10-year perspectives that they say. That's what they do say when they're getting beat up as bad as they are right now. And they do that while their assets and the assets of their investors and followers melt away. I want to look at the real story, and I've got some slides here to show you in which I talk about the Fed and the big trouble that they're in and the big trouble they put us in as they set these hooks over the last 25 years. I think you're going to find this incredibly fascinating. Let's take a look here as we look at the first of the slides. And we're going to look here at the bull markets and bear markets in the last 25 years, essentially. This bull market was from 1994 to 2003. And we're looking at 25 years of Fed and government insane interventions and traps for investors. This will be a little bit of a rant, I know, and some people don't like my rants, but I just want to show you the truth right in here. In the S&P 500 bull market was 6 years long. It rallied 255% from the low that it made in 94. The reset after that, in other words, the bear market following that, was 27 months, 50%. That's when the NASDAQ fell 83% because the dot-com bubble became the dot-bomb bust. Companies with no value were formed. The Fed's role in there was to pour money into the market, especially 1999, because of the Y2K fears. They wanted to put in all the liquidity because all of our computers were going to shut down and nobody was going to be able to do business. Plus their response before that to long-term capital management in 1998, when they cut rates into a very strong economy. So they poured all that money in, easy money finance companies in the dot-com bubble that had little revenues. Companies were created that had almost no meaning to them other than they had a dot-com at the end of their name. It was a huge craze, and investors were sucked in to that craze. What happened was, and you can see in here that we have our momentum indicator in there, and this is the slim ribbon, and the slim ribbon shows you the strength in here as it stays in this positive mode, and all these bars are green. And then eventually you get into a correction and then a bear market. That was 19.2% down at that level. Of course, it has a big bounce after that. That bounce was over 25% or something, or 20%. And then, of course, we got into the real bear market where this all turned red, and that's what happens. In the bear market, as we said, 27 months, 50%, and the Fed set this up in such a big way. It's really sickening. But that was just the first of in this 25-year Fed traps that were set. Here we'll look at 2003 through 2009. The S&P 500 had a bull market that lasted 5 years. It went up 105%. The reset was a bear market of 27 months and 57% right in here. Actually, that looks wrong to me. I forgot to change that. I think that's 13 months. So pardon that error that's in there. This was a result, of course, of easy mortgages. You could get up to 125% mortgage on the value. Yes, they'd give you 25% in cash. It was nutty. Huge real estate speculation, total denial of the real estate bubble. The Fed's role, well, Greenspan, he cut interest rates and kept them too low for too long. And then Bernanke took over and he said, in 2007, subprime issues won't spill over into the economy. Well, you can see in here what happened. Well, it was another nightmare. Again, you had a 20% decline approximately there, and then you moved up about a couple hundred points there, so you had a big rally, and then you got into the real bear market. Of course, the slim ribbon shows you it's bullish, and then the slim ribbon shows you the bear market right there. And again, insane interventions. They want you to feel really rich, so they push everything up. And that is the Fed setting another trap that happened there in 2009. And it was really a horrible thing. I could go back and make this political back into the 1990s, but we'll stay away from that for the moment. Now let's look at the next bull market. Holy cow. 2009 through 2022. You might say that there were some bear markets in here where there was a pandemic crash, but according to our work, that was all within the context of this bull market. The Fed's great experiment. This all happened after that bust of the mortgages, and the Fed went down to ZIRP policy, and the ZIRP policy all the way through this whole period in here. They tried to raise rates a little bit in 2018 right there, but they couldn't do that. The slim ribbon bullish all the way up, as you can see right in here. That 2009 to 22 bear market, a bull market, 12 and a half years, 623%. Historic valuations of 200% of GDP for the stock market. And the bear reset, well, we don't even know yet. It's actually just starting. Massive government spending, huge debt that they took on, promotion of a private debt bubble. They want us all to take on as much debt as they can. Encouragement of big businesses to do all those stock buybacks, of which they had to bail out the airlines and cruise lines and all of those companies right now. And promotion of that wealth effect through the stock market rise, in which right now they need to promote a negative wealth effect. $5 trillion in pandemic response. They created huge distortions. Those PPP loans were insane. The Fed, well, many waves of QE, and ZIRP lasted for 12 years, right, as you can see. And then Yellen, she was actually in there for a long time, of course, before Powell came in. And she is one of the chief promoters of MMT, modern market monetary theory, and sadly she's the Treasury Secretary right now. And Powell, total denial of his role in this, called inflation, well, transitory. And then of course it turned into real inflation that they have no clue how to handle other than to raise rates and to then of course put everybody in that trap. Inflation may be embedded in the economy right now, and we could easily be in a period of stagflation, and they need to respond aggressively and potentially for a long period ahead. I want you to note in here the comparison, 1921 to 1929, before the Great Depression, the market moved up 513% in another long secular upside move that was promoted by Easy Fed, Roaring 20 time period right there, stock speculation on very, very low margins, of course, because they make money cheap, just like happened now. And the bear market, well, 30% plus, depends on where you measure it, down to 1933, and a 90% loss of stock prices right in there. So you can see that things can happen that are pretty ugly. We talked about the slim ribbon telling you about every bear market. You don't even have one in here yet. So far, this is down 19.9%, just like I showed you in those other bulls. And then what happens is you get a rally at some point. The best time for a big pounce based on our analysis starts in late summer, maybe in September, and then I think you're going to get that bounce in here that probably is a pretty good size bounce from, well, I'll show you that later on in the show, from what level we expect it to be down to. So you get into that rally time period in here, we'll call it from sometime in August, September, or October, a false rally that then sets up the next big decline in here, and that slim ribbon will go red, and you'll be in a real bear market, which tends to last for an average of some 13 months and be over 30% on the downside. There is still a lot of correction to go on. Where are we right now? Well, there's that whole thing, 1994 to 2002. This certainly does look like the roaring 20s in here. I'm not calling for a depression. I'm not calling for a 90% decline. I just want to give you the picture. With 25 years of government and Fed intervention, the great experiment, will that result in the great reset? Past market distortions, inflationary and slowing economies, and central banks realizing their errors brought the first wave down, as you see right in here. What's the chance of this being near the end of the bear market? I ask you that after showing you this history. By historical standards, it's just getting started. So I thought that was really important to show you as we see what really the truth is, and all of those analysts out there that are saying, well, this is just a correction. Well, you know, like all bear markets, there are sharp rebounds, and we know that we can see that, and they can last for 2 or 3 months, as we think will happen sometime in the late summer. But by everything I see here, it's time to be extremely cautious. Yes, there will be up days, there will be up periods in here, and there will be rebounds in your holdings. I say don't get hooked into believing that the upside move is more than just a little bounce. And it is not a bull market resumption. I would say the probability of that is near zero. So don't get hooked into believing that. If you do, it will keep you in. If you listen to all of those other analysts out there, well, some of them, that tell you that the bull market will resume, and talking about 5,000 on the upside in the S&P 500. When we see things like this, and we talked about this coming into the beginning of the year, that a bear market was coming, and now this is really the time for the lowest exposure, the smallest risk that you can have in your portfolio on the equity side. Depending on, you make your own decisions based on you working with your financial advisors. I'm just giving you the analysis as I see it. And what I see is that the great reset from this 25-year of madness is just getting started. For the week, the stock market, well, down between 2.5% or 4%, depending on what you look at. Bond market, 30s are gaining about 2 points. The 10 years down about 12 basis points to 281. We think that the bond market has bottomed for at least a while. We've been talking about that bottom forming. And now with yields down from 3.1% to about 2.8, I think they're probably going down closer to about 2.6, and the bond market's got some upside move. Gold jumps about $31, and please do watch Future Speak. We talk about the importance of the time frame we're in right now and the potential for things to be, well, better, to say the least, in the precious metals markets. Dollar down 1.3%. We think there's a reversal in there and that it has temporarily peaked now, with a pretty good chance that we're going to see it move down to about 101 from its peak over 104. Oil market, a sideways week after, or near unchanged, after trading up near that resistance we've talked about 116, it falls down now to about 110. We still think it's going to be in a very wide range. It could take you down into even the low 90s. We have a lot coming up right now. We have a preview coming of our member video. Ari's going to bring you our short-term trade planning that we do, and he's going to look at FDX, Federal Express, with some great analysis. Katie's going to bring you some just beautiful analysis out of First Solar. You're going to love that. And then we're going to continue with our Meet the askSlim team series, where I'm interviewing Katie, and you're really going to love that. Please do watch it. I'm going to do a quick pick on the Dow Jones Transportation Average, kind of extending out the analysis that I just did last couple of weeks, where we can project the bear market. I did it last week in the FANG stocks, and if you haven't seen that, you can see that on YouTube right now. And then I'm going to bring stock market analysis. I'm going to show you our ranking system and show you the conditions in the stock market as they exist right now. And then I'm going to show you the weekly analysis on the S&P 500. So just some great things that we're going to show you coming forward. And I think I've shown you some great things already. Please do go to askSlim.com and explore that website. You can become a free member. You can take advantage of our specials. If you're on YouTube here, do subscribe to the channel. Click the notification bell, and you will know when we put up videos. And do like this video. Give it a thumbs up. That does help us with YouTube. And please share this with traders and friends and family. We want them to become subscribers on YouTube. We want them to become members here at askSlim.com. On Twitter, follow us at askSlim. And any questions on anything you see here on our memberships or analysis, you can write to Matt at askSlim.com. This is a preview of a member video brought to you by Arvi. Avi Ramachandran, one of our great cycle analysts here, and he does these videos every other week on short-term trade planning, does some great teaching in there. And this is just an example of that as he shares with you his analysis on FDX, and he shows you how to set up a short-term swing trade.
So this is FedEx, and this is clearly in a very bearish mode, all set up when we got this breakdown back on 7/26 of last year right here. You can see we were forming a positive setup here where we would look for a move back to new highs. When that didn't happen here and we got the breakdown, everything turned down, and you can see we had this really sharp sell, got a rally, but since we have now a bearish structure with a lower low and a lower high relative to the prior cycle high, we got the failure in the red zone and turned down again and made another lower cycle low relative to the prior low. After that, we got a rally right here, failed in the red zone again, it turned down, got another rally, failed in the red zone again, turned down again. This name is in our focus list, which we update all the time, which is why we have all of these levels here on this chart. So what are we looking for on the downside? Again, looking for a move to the base of this intermediate term fib target zone at 174, going out into this timing, which is due 718 to 822. So that's the overall picture here on the intermediate term in FedEx. If you look at the daily chart, let's bring this over. Again, you can see this really nasty bearish kicker right here on the downside. Now we have a negative ribbon. Any little uptick, we'll be watching for a short trade idea and then a swift failure back down. What are our levels here? You can see we have a key daily cycle low at 192.82, which is really correlating very well with this 61.8 as well. If we get through that level, which is very likely we will, we have a short-term fib target zone from 184.5 to 174.5. So we'd look for a move into that zone, going out into this short-term timing, which is due 615 to 623. So we already looked at both Norfolk Southern and now we are looking at FedEx. So the transports are in a lot of risk here based on our work.
Great work on that, Arvi. Of course, really has just an expert in this with an amazing handle on this kind of analysis. So only a few people in the world really get this, and a handful plus a lot of our members that are learning, and Arvi really is great. So we're staying with cycle analysis in here, of course, because that is our general way that we look at the markets. We do have a great new feature for our members called the Cycle Low Timing Tracker. Katie's going to reference that in here as she shows you great analysis on First Solar, FSLR, in the solar category, of course. Take it, Katie.
Hi, this is Katie with askSlim. Let's take a look at the chart of First Solar. This is a stock that is on our focus list, and right now it is also appearing on our Cycle Low Timing Tracker as a possible opportunity setting up. The Cycle Low Timing Tracker is a tool that we recently released for our Level 3 and 4 members, which highlights potential opportunities setting up around cycle lows in both the weekly and daily timeframes, both coming into cycle lows and coming out of cycle lows. So this is a 5-year weekly chart of First Solar. There are black cycle brackets on the bottom that are 20 bars in length. The gold dashed cycle brackets belong to the Solar Stocks ETF. Now the brackets themselves show an average length of money flow patterns into and out of a symbol, and these purple vertical lines show where the actual cycle lows occurred relative to the average. Notice these blue vertical dashed lines over here on the right. Those show a period of time when we expect the current cycle to make its low and begin to turn up again. So this last cycle right here rallied up to the 78.6% fib extension level and backed off from that area. When momentum turned negative, momentum on the askSlim weekly charts is represented with the proprietary reversal scout. So when momentum turned negative, it was a negative sign that we might have a left-hand translation in First Solar. A left-hand translation is when the cycle peaks toward the beginning of the cycle over on the left-hand side. It's a negative sign because it leaves a long time left in the cycle for a decline, and that is just what happened here. The cycle bottomed much lower than where it began. We call that a negative configuration. So that leads us to the current cycle that we're in. We made this bottom, and then momentum turned up. So you can see that we tagged the bottom of this resistance zone that was created between this high and this low. And then we backed off from that area. You'll notice that momentum has turned negative, and that means that we might have another left-hand translation on our hands. Last week, we broke through this cycle low support. So using the cycle high right here and that recent low, we created this minor resistance zone. And what we're looking for now is for First Solar to try to get up into that zone. And if it can, then we would consider that a good shorting opportunity for one more turn down into this weekly cycle timing between June 13th and July 29th. Let's take a quick peek at the daily chart so you can see that the timing window for the current daily cycle to make its low ends on June 13th. So this daily cycle is in sync with the very earliest part of that weekly cycle timing window. And the next daily cycle ends on July 6th, so that one is also in sync. What that means is that either at the end of this cycle or the end of the next one, we would expect the intermediate term bottom from the weekly chart to form. So because of that, either cycle or both could be expected to show weakness and breakdowns. So the cycle low timing tracker has a whole section dedicated to focused list symbols that are in that exact situation. To learn more about cycle analysis, the cycle low timing tracker, and what we offer in each of our membership levels, please visit us at askSlim.com.
All right, that was great. I want you to know more about Katie, so here it comes. This is the continuing series of Meet the askSlim team. And I'm going to interview right now Katie Anagnostos, and you're going to find this just wonderful. Hi, I have Katie Anagnostos with me, who is our newest analyst. We just brought her onto the team some months ago, and really excited to have her with me. And I wanted to share a lot about how she got here to askSlim, what brought her into the business world, and maybe a few other interesting things. So welcome, Katie.
Hi.
Yeah, glad to have you here. So just, I want the audience to get to know you. So let's get some sense around how you even got interested in trading and analysis.
Well, I became interested in the financial markets. I remember exactly when it was. It was October 19th, 1987.
Oh,
Monday.
yeah.
I was a teenager. And, it wasn't like today. We didn't have smartphones and, computers and internet in the homes. And so my parents would come home from work and turn on the nightly news. And I just remember the images from, the reporting of, Black Monday. And also because it was, something that kind of struck me because I spent a lot of time growing up with my grandmother, and she was a young girl during the crash in the 20s. And grew up in a farming family during the Great Depression. So the stock market was not something that, anyone in our family really messed with, So, sometimes teenagers are contrary and they, don't really want to do the things that their parents and grandparents do, and they question that. And, that kind of, I wanted to learn like why, these crashes would happen, and different effects, from economic policy and things like that.
Wow, that's in my wheelhouse for sure. So that's what got
That
me
is one of
interested.
the reasons that I really liked, listening to you when, I encountered you for the first time.
Well, that's great to hear. So interesting. You grew up in a family that might have passed down some of the depression mentality because
Absolutely.
you had
That's for
grandparents that
sure.
were there at the time, which tends to make families be kind of frugal because of
Yes.
the fear of that happening again. Did you have some of that in your life?
Not so much in mine, but I could definitely see that, in my grandparents. They were, they never had a lot of money, but, they stretched what they had very far. And then, that particular set of grandparents, they had 5 boys. And, I think that they did pass that down to, my father and his brothers.
Mhm. Yeah, I've heard a lot of families that have been that way.
Yeah.
So let's move it a little bit forward in time as got developed from liking the markets to being a trader. Actually, when you got your hands involved in it, and say a little bit about that. How did you start
Sure.
trading, and what
So
what direction did you go in?
I was always reading things in, financial literature, and I had not encountered, anything, in the options world yet. But I was reading an article in a magazine one day, and it was a quote by Robert Kiyosaki, who is the Rich Dad, Poor Dad author.
Mhm.
And he was referencing what I later found out was a covered call. And I just got so curious. I was like, what is he talking about? And I started like Googling about options, and I eventually landed on Tasty Trade, which, you were a part of. And so I started, like doing their Where Do I Start series and following along. And, during the course of the day, I'd listen to some of the segments, and you were always my must see segment.
Oh, that's so nice. Well, I got to say, those guys at Tasty Trade are all old good friends of mine, and you learn from some of the best. So,
Yes, well,
good
it's
for.
been, and I've just been like a options trading fanatic ever since. So
Yeah, and that's one of the things is we were bringing you onto the team that we're real excited about because we all have kind of our own thing that we do, and we know that we want to fill the void that we have for options trading, and the hope is and the expectation is that you're going to be a big part of that, and I believe that the
I can't
skills you
wait.
have are going to be really important to that. So that's great. Love having you on the team. How do you see yourself? In that regard, just a few words or sentences about, what you expect to be teaching or bringing, especially in that option world.
Well, I think that, as you're alluding to, everybody has kind of their own trading style. And we do have a lot of members who are very, very interested in options trading. And I think that it's kind of become more mainstream. And so, because there are so many ways to trade options, you can be, short premium seller. You can, trade mostly long premium, different durations, day trades, longer, the whole 45 days to expiration thing. I think that what I would like us to do is, like put together for example, for some of our trade ideas, like different option strategies that people could choose from depending on, those particular parameters for themselves. And then, utilize maybe our Discord channel to have conversations about those and, what benefits and drawbacks those strategies have, and how best to trade them. I think it would be really interesting and a way for us to engage.
That's really exciting because I just recently had a meeting with Matt and Ivy, and we talked about just that, about, melding the style of analysis that we do with the skill set and the knowledge about options and option trading, putting those back together to really get, I think, increased probabilities for those strategic approaches. So that I think will
Absolutely.
be very exciting. And I know that's coming and you're going to be a big part of that. One other topic I want to talk about on our YouTube channel, we can see statistics on there, and that is the number of male versus female viewers that we have on YouTube. And the shocking thing is that 97% plus of the views are men. And I know that there are a ton of women out there, and a much bigger percentage than that, that are interested in the markets and trading the markets. And I'm just so curious about your perspective. And you're such a great model about, a woman that is trading actively and understands the markets so well. Huge knowledge base that you have. How do we bring women on? Now, what would be the message that you would give that more women would come forth and do this great business we're in?
Well, I think that we have to, just as you said, just be a role model to show women that there are women here. It's not just a men's world, and also to find a way for them to, realize that they can control their money and they can learn how to trade in the market, to do that for themselves, and how it can be really fun. And I belong to a women's trading group, and there's a lot of camaraderie there, and helping each other out. So I think it's just a matter of exposure and being able to get more women to engage this way.
Well, what you just said was exciting to me, because maybe someday there'll be an askSlim women's trading group. So
that would be great. I would love that.
So I really want to encourage the women out in the world who are interested in the markets to, come to us, learn more, and we could be support for them for sure, especially with you on the team as this great model.
I work at another job, and I'm also around a lot of women in that job, and they see me, sometimes working on things for askSlim, and, they ask, and I do get a lot of interest. So that's really good to see.
Yeah. Well, maybe we can figure out a way to encourage women to come on board.
I would love to do that.
We're going to talk a lot about that.
Okay.
All right. That's great. So I want to wrap this up. It's been great having you here. I'm so excited about you being a team member here at askSlim. And you just bring so much to the table here with us. And I know that you're going to be a part of this team well beyond me. So.
Well, thank you so much. It's been a real honor to be able to work here. It was a wonderful opportunity to be able to join this team.
Yeah, I'm really glad that you did. Everybody out there, this is Katie Anagnostos. Really excited about Katie being on the team and the opportunity to do this interview. So that's it for today. Katie, thanks a lot for coming.
Bye, thank you.
That was so much fun interviewing Katie. And we're going to continue this down the road here, not too long. The team is going to interview me. All right. I recently did a special where I looked at the FANG stocks, and I used that information in the FANG stocks to project the next major low point that we see. Now I say major. In the stock market. This is really a lesson in cycle analysis as I look at the Dow Jones Transportation Average. And I'm going to show you how we look at the market, and cycle analysis is essentially a visual depiction of money flows with looking at rhythms in the markets. And you'll see how the rhythms in the Dow Jones Transportation Average are pretty spectacular and give you some really great information. So here is a Dow Jones Transportation Average with cycle analysis on it. Now, our analysis is made up really of three components, which is cycle analysis, which essentially shows you the rhythms in the market, the rally phases, the corrective or declining phases. It also looks at what we call configurations and translations, and you can learn about that by going to our cycle analysis workshop page. There's some free information on there. And we also look at what we call swing high, swing low analysis and fib, extension, and projections, which give us a good sense of the condition of the market. So I'll give you an example. This cycle right in here, as you can see, it's measured from low to low. It has an average period in there that I can show you just simply by highlighting on the bracket right in here. I highlight that, and it says 33 bars. So it's 33 weeks because we're looking at a weekly chart. And you can see that it rallies in here, and it rallied for 30 or 31 of the weeks, and then comes down for only 2 weeks. Excuse me. We call that a right-hand translation because it's so strong and so powerful. As you can see here, we show you with that up arrow. This is almost the same kind of a cycle you can see in here. And remember, these are average lengths in here. And these two lines that you see there, those blue dotted lines, said that the low was going to come somewhere in that time frame right over there. The next one we're going to look at in here, something changed. Well, every time you get a good cycle, bullish cycle, the next one's supposed to go to a higher high, and it did. But what it did was it came down all the way to that low right there. And what that tells us is that something is changing. In other words, the trend or the upward energy is going away. If it can give up 100% of the move, and then, of course, we look at momentum. And when momentum conditions roll over is where you, this is the reversal scout, and that's a proprietary indicator. When it rolls over, it tells you you're in that corrective period, and it did so right in here, and it brought you in that correction. This break in here of 100% of the rally says to us the probabilities of the next rally failing in the sell zone is high. And that's what happened, as you can see right in here. It then rolled over and failed, and this is a left-hand translation. It peaked way here on the left side of the cycle. It leaves all of this period in here to decline. That means money will be flowing out of the transportation average out into September, October is what that looks like. It got below this cycle and low right over here, and that says breakdown suggests a major top. When tops form, they often form in head and shoulders. Why do head and shoulders form? They form because of the cycles. The decline makes the left shoulder. The rally that completely fails makes the head. The rally that fails early makes the right shoulder. And then it breaks down. And then this yellow zone here is where the decline comes. This yellow oval that you can see are the declining phases. And when there's not a lot of time for them, they don't fall very hard. When this one peaked very early, there was more time. And this one has time to fall all the way out into October. So what we would do is then take this right over here. I'm just going to show you how we do that and say, well, the time frame for the next low in here, the range of time, and we do everything in ranges of time, is sometime over here between September and October, where that next low is. The head and shoulders measured move, which comes from the distance from the head to the neckline, and the breakdown to the neckline is down here to about 10,200. That would be some 25% decline here in the Dow Jones Transportation Average, and that is your quick pick in the Dow Jones, as this picture is a really bad one, and it helps us see that the stock market is in a lot of trouble for probably a long period of time. If you didn't see the beginning of the show where I showed you about the bull markets and bear markets and the traps set by the Fed, I talked about the fact that, well, there was a rally coming maybe late summer that was meaningful, and this really goes along with that analysis. So I wanted to show you that, the quick pick. It's a weekly cycle analysis on the Dow Jones Transportation Average. All right, stock market analysis. We're going to look at stock market conditions first, looking at our rankings system. The ranking system is very unique because it has our programmed algorithms in there and gives you conditions with a sum of the evidence condition on the 84 best traded symbols. Those would be the 48 best stocks, 12 best ETFs, and the 24 or so futures and indexes that we look at. So what I'm going to do is I'm going to go to the askSlim page because I want you to see how to access this. If you are a member, people that can access who are level 3 members or level 4 or 4 plus can access it. I'm going to go to the workbench right over here, and I'm going to click on that, and you will see what the workbench looks like. Actually, this is showing you some things that are for a level 4 level 4 plus members. They can access they can ask for specific analysis, and then we do custom analysis for them, as you can see in here. And then level 3 members get to see that analysis, but don't actually get the links for it. Here's a trade ID on Taiwan Semiconductors. You can see what was put in here in this timeline that goes in there. But I really want to show you the rankings is what I want to do. And I'm going to click on rankings, and it's going to open up the rankings page. This is the Slimulator ranking system. And I'm going to go down here to that page right there. It'll take a moment to load because all these algorithms are running live. And you get an idea of what we have in here as we have the symbol, the directional bias, the outlook for the next 3 to 6 weeks, and then the conditions, long-term, intermediate, short-term, and the option bias indicator, and the charts that are in there. Just click on here and the charts pop up. So what I want to show you is that the sum of the evidence essentially gives you this outlook right here. And you can see here looking at these stocks. I really want to go down to the stock market right in here, which has the information that I want to share since we're doing stock market analysis. I'll leave it right there. You can see in here that the gold market there is neutral, that's GDX and GC, but we're just focusing in here on the very bearish conditions, as you could see. Long-term, intermediate term, short-term, option bias indicator, all giving you very bearish conditions. And it's been like this for a long period of time. And this is important when you put all the pieces together. If you, I'm going to show you the chart for the S&P 500 in a moment, and clicking on here would essentially open up that chart. But I wanted you to see these conditions as they exist in there. And interestingly, the option bias indicator is, when it says N2, it's slightly oversold. N3 means it's not oversold. There's a big momentum on the downside yet. And that's the difference between what you see here. Favors short side bias, suggests very strong negative conditions. The S&P 500, because it is slightly oversold, is giving you just a slightly different reading in there. But this is the extreme bearishness that all of our sum of the evidence is suggestive of. So I wanted to show you that so you could see the conditions in here. And you can see the 84 different symbols that we look at are all in here. Take a look at Bitcoin. You can see that very, very bearish. This is just a great app for level 3 and 4 members. So I thought that was important because I wanted to show you the condition of the stock market. If you want to become a level 3 member, this is the an offer that we have right now, and there are 10 reasons to become a level 3 member. You get our ranking system I just showed you, our daily trade ideas, our stock index report daily snapshot, our SIR live stream for scalpers, chart streams live that gives you all of our proprietary indicators on 11 of the key indexes, in futures, also the Slimulator Momentum Tracker for investors, our 600+ video library, it's new cycle load tracker, new askSlim Discord server where you connect with the community and talk to our team, and the new Futures Hub, which is just mind-blowing. It's so good as a spot to go see all of our analysis. We have a special right now, 1 month, 50% off for $59.50 versus $119 a month for all of that, or save even more money. You save $125. It comes out to $77 a month if you subscribe for 3 months. You want information on that, write to Matt at askSlim.com, or if you want to sign up now. Way up over here you can see on the front page we're in our last 2 days of this special, so don't miss this opportunity to get that ranking system and so much more. So wanted to show you that and let you see the ranking system and the condition of the stock market. Looking at that. Well, let's get back to the stock market now. We're going to look at the S&P 500 weekly cycle analysis. Stock market now really coming apart now as I'm doing this analysis and breaking some very key levels in the stock market as sellers have come in very aggressively here on Friday. Let's switch over to the S&P 500 SPX, and there is a lot of meaning to the level that we see the market moving down to right now, and I'm going to show you that as we zoom in on this weekly chart. First of all, if you did not see the beginning of the show with the my showing of the last 25 years and the traps that the Fed has set, then I think it's important to go take a look at that right now. Because the stock market is falling very hard as I speak, with the S&P 500 down almost 60 points after being up 40 earlier in the day. So there's that big pandemic bubble, this big rally pushed up by the Fed and the government during the pandemic period. And now let's look where we are. So this is the weekly analysis on the S&P 500. The top was set in this cycle right in here, which has this negative configuration as we have shown. Many times discussed this. The rally in here that we got was, the highest probability was that it would fail in this area right here in these resistances and then move down. The fact that it got down under these levels right over here says that the head and shoulders top was completed, as I showed earlier in the show also, and then it began to move down. It left this tail right over here. Now, there was a low that was due right over here, and we thought we'd get a rally. Now, we don't know whether that was the rally and it ended in a week, or this is the rally. Actually, there is no rally in here, and to be looking for a rally now seems like, well, it's almost silly. The what happened was that now that this low has broken right over here, it sharply lowers the likelihood of reaching the resistance level up here that we talked about. That was around between 41.35 and 41.50. That was the expectation, that there would be a bounce in here. But now, because of breaking these lows over here, what it does is it tells us that we're really in this channel right over here moving on the downside. And that the likelihood is that the minor resistances will stop an upside bounce. Now, these are declining right now, and I haven't updated them yet. So what it says is that you could probably get a bounce up in the area of 40.25 to maybe the center, this area here, about 40.75. That would be where we would expect the bounce to come and then be moving down again sharply. So there is likely to be several waves on the downside right over here, and our projection is for that August to October bottom right over there in these, in following this downward movement. There will be big rebounds in here where the market does try to come back. And that is likely to really hook some people in. Again, these minor resistances are the areas that we're looking at right now between 40.25 and 40.75. 40.25 to 40.75 is a best case that we can make right now because the minor resistances are now coming into play. They were not until we got under this level based on cycle analysis. So we're now running past this ideal low. It means that these rallies in here somehow were the rallies that, that began this next rising phase. And while there's an outside chance that you get another rally in here and we start to wonder about whether or not it's that rising phase, the chances of getting up through the minor resistance zone is very small. So we're going to look for rebounds to potentially occur, getting somewhere over the 40,000 mark, and those numbers are falling right now based on getting under this level, and then continuing to move down with that real bottom expected out in October. Now, one more thing I want to talk about. We talked about in the beginning of the show the potential for an extension of the bear market that lasts for a much longer period of time. This next cycle, this next harmonic family of cycles out there, aligns with what we look at as far as our very long-term picture. That's the 7-year cycle, 28-quarter cycle, all of that. It is very unlikely, in my opinion, that a bear market ends in here. It's much more likely that it extends out here to February of 23. I want to keep that in mind and introduce that idea. And yes, in the beginning of the show, I talk about the potential for the big rally that occurs sometime late summer, and that would be off of these lows that we're projecting out over here. And that could be a rally that gets you from, let's say, 3,500 all the way up to over 4,000, 4,200. That's possible. And in my opinion, that would be just a hook. Talk about those hooks a lot in the beginning of the show, so I want you to go back and look at that. So this is the bigger picture as we see it right in here. The big pandemic bubble ending, the bear market in here beginning, and the downward breakdown from that low that we see right there, suggesting of lower rebounds, but still the potential for some rebounds coming. Right now the market is getting sold off very hard as the market is really being overwhelmed by the people that have to sell. That's what's going on right now in this liquidation. There'll be periods where it ends, there'll be rebounds, but then moving back down to the downside. That's it. That's everything I'm going to show you today. I hope you found it incredibly fascinating. Please do go to our website, explore around over there, become a free member or a premium member on YouTube. Subscribe to this channel, click that bell, like this video, give it a thumbs up, and watch our member videos in the playlists, and you'll learn a lot more about what we do. On Twitter, follow us at askSlim. And any questions you have about anything that was shown here, please write to Matt at askSlim.com. That's it for this show. I want you to be so incredibly careful. It is so crazy out there. And I'm always wishing you great trading.